This is Nightly Business Report with Sue Herrera and Bill Griffin.
Flying high, the bulls charge Wall Street as the Dow and the S&P close at records. But which stocks are still worth owning at these levels?
Upwards march. Mortgage rates hit their highest level in years, potentially scaring off some home buyers who've never seen rates like that before.
In the market for a car, you can buy, you can lease, and now there's another option, subscription. Those stories and more tonight on Nightly Business Report for this Thursday, September the 20th.
Good evening, everyone, and welcome. What a day on Wall Street. The Dow closed at its highest level ever, its 100th record finish since the 2016 election. The S&P 500 also closed at an all-time high. The Nasdaq is ever so close, and investors have been turning their attention to the strong economy and away, for now anyway, from trade concerns. So let's get right to the numbers for you. The Dow Jones Industrial Average rose 251 points to 26,656. The Nasdaq was up 78, and the S&P 500 added 22. Bertha Coombs has more on Wall Street's record day.
It seems counterintuitive that the Dow and the S&P 500 are hitting records just days before new U.S. tariffs on $200 billion in Chinese goods go into effect. But investors are convinced officials in Beijing and Washington ultimately want and need to resolve the trade conflict despite the heated rhetoric. And that sent stocks much higher. The Dow was the last of the major averages to top its recent high this year. Today's session saw a broad-based rally with new records for the healthcare and consumer discretionary sectors, and investors moving back into recently beaten down tech shares like Facebook, Apple, Amazon, and Alphabet, the large cap tech names which have led the market higher for much of the year. Tech also got a lift from Microsoft, one of the 5 Dow components hitting all-time highs today. And the stock market highs did not go unnoticed at the White House. President Trump tweeting, "Congratulations, USA." That underscores what a number of traders believe, that the president sees the market as a barometer of his economic policies, and if tariffs negatively impact company earnings and stocks, the White House will likely back off from draconian trade measures. For Nightly Business Report, I'm Bertha Coombs at the New York Stock Exchange.
So Bertha just mentioned one of the risks to the market being tariffs, but there are others as well. And as Steve Leisman reports, for the most part, they're being ignored.
Fears over a trade war was rocking stocks yesterday.
Stocks are under pressure. The trade war with China escalating.
The market is clearly concerned about trade wars and tariffs.
Fears over a trade war slam stocks, full coverage of that big move.
Up until now, stock markets reacted negatively to almost all threats of higher tariffs. But since President Trump slapped $200 billion of new tariffs on China Tuesday and China retaliated, it's been a different story.
Markets having a very good day. Stocks rallying broadly this morning.
Stocks are surging. The Dow hitting a new record for the first time since January.
Market sentiment has changed with respect to the tariff story, and it should have in the first place, because tariffs amount to only about 0.4% of world GDP, minuscule in the larger scheme of things, and so markets have been able to shrug it off.
And tariff threats aren't all the unflappable bull market is looking past. The 10-year Treasury yield is now convincingly trading over 3%. With most of the increase happening right around the tariff news, which prompted many economists to raise their inflation forecasts. Along with higher rates have come higher probabilities of Fed rate hikes. Markets now see a 100% chance of a quarter-point rate hike in September and a 76% chance for another hike in December. Markets now see the first 2019 hike coming 2 months earlier, in March instead of June. Why ignore the headwinds?
Revenue growth is strong. As long as you have a good macroeconomic backdrop, which we expect. You long have a measured 10-year rise. There's a lot of good news.
And plenty of news that investors not too long ago thought was bad, that they've now decided is either outweighed by good news or maybe not bad news at all. For Nightly Business Report, I'm Steve Leisman.
So where do stocks go next? Tobias Lefkovich joins us now with his outlook. He is the chief U.S. equity strategist over at Citi. Good to see you again, Tobias. Welcome.
Nice to see you, Sue. How are you?
I'm good, and the market seems to be good, but you think perhaps investors are a little bit overly enthusiastic, too bullish about this market?
Well, we trend to measure this in a variety of ways. So one is our panic euphoria model, which is a proprietary sentiment indicator. And we're back in euphoria, and we have been for the past couple of weeks. The last time we were here, so it was back in January, right before the market took a little bit of a bath in February. And we are still concerned about kind of 4 items that, 2 of which you've mentioned, trade and inflation and Fed reaction to it, but 2 others, the midterm elections as well as earnings estimates for next year. They're a bit too high, not terribly, but they need to kind of scale back a little bit. And those kind of things could wobble the market. We're not looking for anything huge in terms of a pullback, but we do think the markets are a bit ahead of themselves.
And in fact, Tobias, the S&P has already exceeded your estimated close for the S&P by the end of the year. You thought 2,800, 2,850. We're above that, well above that right now. So now what? Do you raise your estimates, or are you looking for a correction of some kind?
Well, Bill, I couldn't tell you if I was going to raise our target before I did it anyway. But no, our sense here is that, it's breaking news. I know that, but I don't want to get in trouble with the SEC. The bigger issue, though, is if you were to look at 2 to 3% type inflation rates, which is where we're at right now, typically the market trades, if we go back to 1960 and look at that, markets trade around 18 times earnings, which would get you about 28.40. It's not how we get to our targets, but it's a simple way to kind of define where we are in the markets already. Earnings growth is going to slow by the fourth quarter into the first quarter of next year. We're not going to get all that wonderful news from the tax cut again in 2019. And generally speaking, the economy's fine. I don't have an issue with that. But more about where markets are pricing. A fair amount of good news is already priced in.
Right.
And it almost seems like it's ignoring some of the concerns.
So you mentioned those 4 triggers that we need to watch: midterm elections, inflation in the Fed, trade, and earnings estimates that are too high. So where should investors put their money to perhaps hide or hedge against any of those 4 occurrences?
So hiding is tough in a market that goes down. Diversification is kind of the best way to do it. But if you are worried about more volatility in markets, and most investors aren't, but if you do think that this could occur, the healthcare names, and particularly pharmaceuticals and biotech, tend to do better. They're not really going to react to what Jay Powell says at a Fed hearing or a congressional hearing, but rather they're going to be focused on more like product pipelines, new approvals from the FDA on a new product, getting through, those type of things. So I would look at that in the growth component. We're a little concerned about how far tech has run. We'd be looking at financials, and we'd be looking at energy, which are not real favorites in the markets.
Right.
But if bond yields are going up, typically financials do much better.
On that note, Tobias, thanks so much. Tobias is with Citi.
Thank you.
And later in the program, a strategy session on stock picking with the market at these all-time highs. Bill?
In the meantime, existing home sales remain steady in August following 4 straight monthly declines. That was according to a new report out this morning from the National Association of Realtors. And while demand for housing does remain relatively high, there's a new headwind hitting this market. It's both affecting buyers and sellers. Diana Olick has more on that.
There are finally more of these compared to last year. August saw the first annual increase in the supply of homes for sale in over 3 years. But that good news is tempered with a tough new reality. Mortgage rates are rising again, knocking at the door of 5% on the 30-year fixed. While that may not seem historically high to older generations, it is the first time most millennial homebuyers have seen it. The Realtors' chief economist, Florence says not only does that price some younger buyers out, but it keeps more current homeowners in place.
14% of realtors are indicating that when they are speaking with their clients, that clients do not want to list their property because they like their current low mortgage rates.
And that just exacerbates the already critical supply shortage, especially on the low end of the market where housing is most in demand. That was clear in the August figures. Sales were down 12% for homes priced under $100,000, but up 12% for those priced over $1 million. There are far more million-dollar homes available than cheap homes.
We have a good economic backdrop. Jobs are being created. Very high net worth for people who have exposure to housing equity as well as the stock market. So the upper end market is moving.
Higher interest rates, however, could help cool today's inflated home prices. In California, the priciest market in the nation, sales have dropped dramatically and the big price gains are finally shrinking. For Nightly Business Report, I'm Diana Olick in Washington.
The stock market is getting a makeover. Some of the most recognizable names, including Facebook, Twitter, and Google, are being reclassified. Mike Santoli takes a look at tomorrow's big sector shakeup.
Wall Street's most widely followed benchmark is about to undergo a major reshuffling, one that will place some of its leading stocks in different packages under new labels. Standard & Poor's is creating a new sector called communications services that will replace and enlarge the S&P 500 index's current telecommunications sector. A cluster of stocks now categorized as information technology or consumer discretionary will join telecom giants AT&T and Verizon in this new sector. Facebook and Google's parent Alphabet will move from tech to the new communications grouping, with cable and traditional media blue chips such as Comcast and Walt Disney from consumer discretionary. The rationale behind the shift is to collect all varieties of communications and media companies together, given similar business drivers of advertising and subscriptions. The revamp will also reduce, at least cosmetically, what has become a fairly extreme tech weighting in the S&P 500. Tech is now about 26% of the value of the S&P, its highest since the late 90s tech bubble. After these changes take effect after Friday's market close, the tech weighting will fall to 20% or so. Communications will amount to about 11% compared to 2% for telecom now, and consumer discretionary will slip to 10% from 13%. Investors in the overall S&P 500 or in a diversified large stock portfolio should see no real impact from the changes. Owners of sector exchange-traded funds will see substantial changes, though. There's already a communication services ETF trading in advance of the formal shift, and it is dominated by Alphabet and Facebook, which together make up more than 40% of its value. The S&P Tech Sector ETF, meantime, will become enormously dependent on Apple, which will comprise about a fifth of the fund. Consumer discretionary will be driven even more by Amazon, which will remain the largest member of a smaller sector. And finally, investors who relied on telecom sector index funds for their generous dividend yields will need to look elsewhere. On the surface, it seems these shifts will better balance out the S&P 500 with a more rational classification scheme, but there's no hiding the outsized influence of what we typically think of as tech stocks, which will now effectively dominate 3 of the 11 industry groups. For Nightly Business Report, I'm Mike Santoli.
Time to take a look now at some of today's upgrades and downgrades, and we begin tonight with Caterpillar, which was upgraded to outperform from neutral at Baird. The analyst there says demand growth will continue into the next year. Price target now $191. The stock rose 2% today to $156 even. Ralph Lauren was upgraded to neutral from underweight at Piper Jaffray. The analyst there says earnings estimates are likely to go higher for that company. Price target now $125. That stock gained more than 1% in today's rally at $136.17.
General Electric's price target was cut to $10 over at J.P. Morgan. The analyst expects weaker results for its power business. The rating remains underweight. The stock fell 3% to $12.46. Skechers was downgraded to market perform from outperform at Cowen. The analyst cites growing inventory levels, and the price target is now $28. The stock fell 4.5% to $26.58.
Still ahead, why one business owner says don't toy with tariffs.
It has been a tough year for the toy makers, as many lost a major partner when Toys R Us filed for bankruptcy and then closed its doors. Now that industry is facing another blow, rising costs from tariffs. Elon Mui is in Norristown, Pennsylvania for us.
It's sticky, it's stretchy, and it's smack in the middle of America's trade war with China. Aaron Muterick invented a new kind of silly putty 2 decades ago. It's got the same squishy feel, but it never dries out, and it comes in fun colors like good as gold and dinosaur poop. His company, Crazy Aaron's Putty World, employs 85 people and does millions of dollars in sales each year.
But now his putty is in peril as tariffs on Chinese goods drive up his prices.
It's been kind of a 1-2-3 punch this year.
First came the steel and aluminum tariffs. Those raised the cost of the metal tins that the putty comes in by 6 figures this year. Then came the tariff on silicone, the main ingredient in putty. Prices shot up by double digits. Now, the latest round of tariffs will hit the pigments that give his putty its distinctive look.
it's a global market. That price is really the same everywhere. It's not a price where it's cheaper in China and it's more expensive in the United States. But by throwing up that barrier, it's going to add restriction and constraint to the ability of that global supply to move around. The prices are going up.
The company is feeling the squeeze, even though all its materials are sourced right here in America. Aaron has been stockpiling supplies in case prices go up even more, and workers say they proudly stand behind their putty.
I don't think it affects us. I still will buy it. It's still really good putty.
But President Trump is threatening tariffs on all Chinese imports. The Toy Association estimates that a 25% tax on everything would cost 68,000 jobs and $3 billion in lost wages.
For Crazy Aaron's, the tariffs mean thinner profit margins and delayed investment in marketing and overseas expansion. Christmas is the busiest time of year, and Aaron is hoping that will help make up for his higher costs. But he's already locked into price commitments with major retailers for next holiday season, and he's not sure how he's going to keep those promises.
I'm hopeful that we'll just find a way to keep shaving, keep finding efficiencies. I don't want to do things like reduce the amount that goes into every container or move to smaller size containers, because I think kids deserve more.
For Nightly Business Report, I'm Ilan Mui in Norristown, Pennsylvania.
Profits stall at Thor Industries, and that's where we begin tonight's Market Focus. The RV maker reported weaker than expected earnings and a decline in revenue as it scaled back production and worked to reduce inventory levels. The company also cited higher material costs. Shares fell nearly 13% today to $91.95. Under Armour said that it is now going to cut 3% of its global workforce as part of a restructuring. That translates into about 400 jobs. The athletic apparel maker now expects the overhaul to cost more than initially thought, but at the same time, though, it is raising the lower end of its 2018 earnings outlook. Under Armour shares rose by 5% today to $18.15.
The battle between Comcast and 21st Century Fox over TV broadcaster Sky will come to an end this weekend with a final bidding war. British regulators will hold a rare auction that will put an end to nearly 2 years of offers and counteroffers for that European company. Comcast shares rose 1% to $37.81. 21st Century fell a tick to $44.57. A reminder that Comcast is the parent company of CNBC, which produces this program. And after the bell, chipmaker Micron quelled fears of a slowdown in the chip market. The company said stronger demand for its products in several categories resulted in earnings and sales that beat expectations. Micron shares were volatile in after-hours trading. They ended the regular session up 2% to 46.06.
So with all the market at records, stock picking becomes a little harder, you would think, but it doesn't have to be. Joining us tonight for a strategy session is Hank Smith. He's Chief Investment Officer at Haverford Trust. Hank, always good to see you. Thanks for joining us tonight.
Good evening. Good to be with you.
Last week, Ray Dalio said he thought we were in the late innings of the economic cycle right now. You think we're only about halfway through. Why?
Well, actually, I think he said the 7th inning, so that really isn't late, and we might even have extra innings. Bull markets almost always end in anticipation of a recession, and it's highly likely that we have a recession on the horizon over the next couple years. And in fact, this will end up, we believe, being the longest post-World War II economic expansion and the longest bull market.
So what do you say to those who we interview and they say, you know what, this market, many of the stocks and components of it are overvalued? You don't agree with that, obviously.
No, we think the market is fairly valued. It's selling at about 17 times next year's earnings. Historically, the market sells at about 16 times earnings. So it's certainly not cheap, but we don't think it's overvalued. And in fact, this year we've had such tremendous earnings growth, the market is cheaper today despite being up 10% than it was at the start of the year.
Be that as it may, though, you are pounding the table here tonight with high-quality stocks. You're going with high quality. In fact, you're going with 3 Dow components: Johnson & Johnson, J.P. Morgan, and Dow DuPont. Why those 3?
Right. Well, look, first of all, I think investors should own stocks that they can hold for the long term, which means during the good times and the bad times. That is the key to success, as being a long-term shareholder. And you can't get higher quality companies than these. JP Morgan is the best run bank in the world. It has a fortress-like balance sheet. It's returning capital to shareholders. They're increasing their dividend in October 43%. J&J is the best managed healthcare company there is, with an enviable track record of increasing its dividends consecutively over 50 years. And DowDuPont is a unique opportunity to take advantage of a company that's going to be splitting into 3 component companies this year. And the track record of spin-offs is a very, very good record indeed. And so we expect to own all 3 spin-offs. DuPont, which will be the specialty chemical, Dow, which will be the material company, and Corteva, which will be the agricultural sciences company. They'll all be investment grade, all pay dividends. We like all 3.
All right, very good. By the way, I'm an old LA Dodgers fan, and we tend to leave the stadium after the 7th inning, so that's why I was calling that late innings at this point. Hank Smith with Haverford Trust. Again, thanks for joining us tonight.
Good to be with you.
The number of Americans applying for unemployment benefits fell to a fresh 49-year low, in part, though, because of Hurricane Florence. Applications in South Carolina dropped by an unusually large number as government offices closed and the power went out. And today, many homeowners are sorting through the damage and the flooding, figuring out what insurance will cover and what it will not. Seema Modi is in Kingston, North Carolina.
60 miles inland from the coast, and the Neuse River is still rising here in Kinston, North Carolina, flooding gas stations, local businesses, and wreaking havoc on homeowners. That's because many of them do not have flood insurance, since they're not in a designated flood zone. Only 335,000 homeowners in North and South Carolina have flood insurance, which means a majority of residents will have to pay for repairs out of pocket.
After the flood, it's a little too late, but I hope this is a wake-up call to people that everybody needs flood insurance.
North Carolina's Department of Insurance has set up camps across the state for residents to meet with insurance companies to begin filing claims and answer questions for those who may have no insurance at all.
I'm not insured. That's why I'm out here talking with FEMA. That's, I heard about this right here, and so I came out here to see what help can I get.
How much damage do you think you have at home?
Oh, well, a few thousand. That's all I can say.
Uninsured residents have 2 options. Apply for a grant through FEMA, which will likely get you a couple $1,000s, or seek out a federal loan, but there's no guarantee you'll get it. For homeowners with a mortgage, Fannie Mae says they're eligible to stop making payments for up to 12 months without incurring late fees or delinquencies. That buys some time for those affected by Florence, but for others, the financial toll has only just begun. For Nightly Business Report, Seema Modi, Kinston, North Carolina.
Coming up, need a car? Well, if you don't want to buy or lease, we now have another option.
Wells Fargo is cutting jobs up to 26,000 over the next 3 years. That's 5 to 10% of its workforce as part of its turnaround plan.
Those looking to get a new car typically take out a loan or sign up for a lease. But now there's another option. It's called auto subscriptions. Phil LeBeau tells us how they work and why they're becoming more popular.
Melissa Andre loves her Porsche Boxster, the perfect car for Southern California. But Andre is an event planner who often spends months on the road, so she wanted to avoid paying for her Porsche when she wouldn't be driving it. The solution? A monthly auto subscription through the startup called Fair.
for me, it just kind of makes sense to be able to move for a chunk of time and not worry about giving my car back or finding a home for it.
Auto subscriptions are a huge change for an industry where millions typically pay for their car through auto loans or lease deals. That usually means a monthly payment for several years. Now, automakers from GM to BMW are testing if auto subscriptions can generate more business by offering customers the flexibility to rent a vehicle for a shorter period of time, a feature Volvo drives home in its commercials.
It's as easy as getting a new phone.
Fair offers month-to-month subscriptions for thousands of used cars and trucks.
Americans are already at a place where we understand that we pay for what we want to use, and this idea that the car is a service and that it doesn't have to require this big burden of debt.
That's one reason why Melissa Andre is happy to have her Porsche, but not the big loan that would go with paying for it over 5 or 6 years.
It's as easy as getting like a cell phone, except you get a car.
Fair has more than 18,000 subscribers, with many of them making money driving their cars for rideshare companies. Everyone puts down a 2-month deposit, but after that they can change vehicles as often as they want and end their subscriptions when they want. A new way to pay for getting a set of wheels. Phil LeBeau, Nightly Business Report, Chicago.
Forbes magazine is out with its annual list of the most valuable franchises in the NFL. And by the way, the league itself is still the most lucrative sports league in the world. In the top spot for the 12th consecutive year, the Dallas Cowboys, now worth $5 billion. The first team to reach that valuation. New England Patriots are number 2 at $3.8 billion. The New York Giants round out the top 3 worth $3.3 billion.
And that is Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. We'll see you again tomorrow.